If you're a homeowner above the age of 60, pause everything for a moment because in 2026, the IRS quietly introduced a rule that could end up costing you thousands of dollars, and most retirees have no clue it even exists. This involves your house, your nest egg, and your long-term financial stability. Here's what isn't being discussed on the nightly news. This updated IRS policy specifically impacts homeowners. And if you fail to take the proper actions before the deadline arrives, you might find yourself paying money to the government that you never expected to owe. I understand what you may be thinking. I've had my home for years. I follow the law. This shouldn't affect me. That's exactly what countless seniors believed right before they were caught off guard. Whether you're thinking about selling your home, transferring it to your children, or simply staying in place and enjoying retirement, this rule changes the landscape entirely. The positive side is there are completely legal ways to safeguard yourself, but only if you move quickly and understand exactly what steps to take. In this video, I'll explain what this IRS rule means for you, who is most impacted, and the 3 straightforward steps you can take right now to protect your property and your finances. But before we get started, if you know another senior homeowner who should hear this, hit the like button so YouTube shares this with more people who need it. Let's look out for one another. Now that you understand what's at risk, let's dive into the details. Because knowing how this IRS rule works isn't just helpful, it's essential for your financial well-being. I want you to grasp every part of this so that by the end of this video, you feel informed, confident, and ready to act. Let's begin at the foundation. For many years, homeowners in the United States, especially seniors who have owned their homes long-term, have benefited from something known as the home sale exclusion. This part of the tax code allows you to avoid paying taxes on a large portion of the profit when selling your primary residence. If you are single, you can exclude up to $250,000 in profit. If you are married filing jointly, that amount increases to $500,000. This has been the standard rule for a long time, and millions of retirees have depended on it when selling their homes to downsize, relocate, or transition into retirement living. Now here's where things become more complex. In 2026, the IRS, along with new legislative updates implemented this year, introduced revised rules that affect how that exclusion is calculated, who qualifies, and when it can be reduced or even completely removed. And this doesn't only apply to selling your home. It also affects people planning to pass their home to heirs, those who have rented part of their property, individuals who used a home office, and even those with reverse mortgages. In simple terms, this impacts nearly every homeowner over 60 in some way. Let's go through the most important changes, starting with the residency requirement. Under the previous rules, you needed to live in your home as your primary residence for at least 2 of the last 5 years before selling to qualify for the exclusion. That sounds straightforward, right? Live in your house, sell it, and avoid taxes on a significant portion of your profit. However, the updated IRS guidance has tightened what qualifies as a primary residence and how that status is verified. In real terms, if you've been spending large amounts of time elsewhere, such as months each year at a vacation home, a second property, or with family in another state, the IRS may now question whether your declared primary residence truly qualifies. They examine factors like where your mail is delivered, where you vote, where your vehicles are registered, where you receive health care, and even utility and credit card records to determine where you actually spend your time. For seniors who split their time seasonally, such as spending winters in warmer states and summers elsewhere, this is especially important. If the IRS decides your primary residence is different from the one you plan to sell, your entire exclusion could be jeopardized. Now let's move to the second major update, which affects many seniors who may not even realize it. If you've ever rented out part of your home, even casually, such as a room on Airbnb or to a friend or relative for a small payment, the IRS has clarified that any portion used for rental purposes can reduce your sale exclusion proportionally. While this concept isn't entirely new, enforcement has become much stricter in 2026 and thresholds have shifted. What does this mean financially? Imagine your home has increased in value by $400,000 since you purchased it. That's a great outcome and often reflects years of smart decisions. But if 20% of your home was rented at any point in the last 5 years, up to $80,000 of that gain could now be subject to capital gains tax, even if you fall within the general exclusion limits. Depending on your retirement income, that tax rate could be 0%, 15%, or even 20%. Add the potential 3.8% net investment income tax for higher earners, and you could face a tax bill of $10,000, $15,000, or even $20,000 or more on a sale you assumed would be tax-free. This is not theoretical. Real seniors are experiencing this right now when they sit down with tax professionals and realize their expected proceeds are lower than anticipated. Let's continue because the third change impacts a specific group and is often misunderstood. If you've used part of your home as a dedicated office space and claimed tax deductions for it, the IRS has always required depreciation recapture when you sell. That's not new. However, in 2026, the way that recapture is calculated has changed, and the tax rate applied can now be higher in certain situations. Previously capped at 25%, some cases now apply ordinary income rates, which could significantly increase your tax burden depending on your total retirement income. I know this is becoming complex, so let me pause and clarify something important. You don't need to memorize every detail or become a tax expert. What matters is recognizing these changes exist, understanding they likely apply to you, and realizing the smartest step is to consult a qualified professional before making decisions about your home. Even a few hours with an expert could save you tens of thousands of dollars. We'll discuss how to find the right help shortly. But first, let's address a common question. What if you're not planning to sell your home? What if you intend to stay and eventually pass it on to your family? Does this still affect you? The answer is yes, and in some cases, even more significantly. Traditionally, when you pass your home to heirs, they receive a stepped-up basis. This means instead of inheriting your original purchase price, they inherit the home's market value at the time of your passing. For example, if you bought your home for $80,000 and it's worth $600,000 later, your heir's basis becomes $600,000. If they sell soon after, they may owe little to no capital gains tax. This has long been a powerful tool for transferring wealth. However, the 2026 updates introduce new limits and reporting requirements related to this rule. Estate thresholds have changed, and how trusts and transfers interact with basis calculations has evolved. The IRS is also paying closer attention to property transfers between family members, especially those occurring near the time of death or structured to avoid taxes. Estate planning is still very much possible, but strategies that worked before, such as adding a child's name to a deed informally, may now create unintended tax consequences. For example, a grandmother adding her daughter to the deed could trigger gift tax reporting, reduce stepped-up basis benefits, and potentially create capital gains issues. What seemed simple could become costly due to rule changes. The key takeaway is that the rules have changed, and most homeowners are unaware. You won't typically hear about this in everyday conversations. The people who understand these changes are tax professionals and financial planners. Without seeking that knowledge, it's easy to make decisions that unintentionally cost money. Now let's focus on what you should do. First, gather your documents, including purchase records and receipts for home improvements, as these increase your cost basis and reduce taxable gains. Second, review how your home has been used, including rentals, business use, or shared arrangements. Third, understand how any mortgage, especially reverse mortgages, affects potential sales or transfers. Fourth, consult a qualified expert who specializes in real estate and retirement planning. Fifth, ensure your financial advisor is aware of these rule changes and discuss how they affect your situation. Beyond finances, remember your home carries emotional value. It represents memories and security. While tax rules may feel intrusive, they are manageable with proper planning. Knowledge is your best protection. Timing also matters. Selling a home can affect income levels, potentially impacting tax rates, Medicare premiums, and Social Security taxation. Proper planning can help minimize these effects. If you own your home jointly, planning must account for both individuals, including what happens if one passes away. Family financial arrangements should also be reviewed to avoid unintended consequences. Delaying action can be costly. Waiting too long often leads to missed opportunities and higher taxes. Even if you're not selling soon, updating your estate plan is essential. Laws change, and outdated plans may no longer be effective. Your home is likely your largest asset and deserves careful attention. I began by saying this is urgent, and now you understand why. This isn't about panic, but about being informed and proactive. You've worked hard for your home, and you deserve to protect it. These rules can be managed with the right approach. Your next steps are simple. Gather documents, review home usage, consult a professional, address any complex arrangements, and involve your family in discussions. Thank you for watching. If you found this helpful, share it with others. Like the video, leave a comment, and subscribe for more important updates. Your financial future, your home, and your legacy truly matter.